What's up guys, and welcome back to the YouTube channel. My name is Saman Habibi, your real estate agent for the Durham region. As always, we're going to leave my link here below. If you want to talk about anything related to your personal real estate portfolio or what you'd like to achieve, feel free to book a call with me. Today, I have a very special guest with me, Vlad. Thank you for joining me.
My pleasure. Thanks for having me.
Why don't you give everyone an introduction of who you are, your firm, what you guys do, and we'll jump into it.
Absolutely. So my name is Vlad. I'm a Canadian CPA. I'm also a US CPA. So my firm provides Canadian and US tax services. We have two offices, one in downtown Toronto, one in Etobicoke, and we focus on providing value for our clients from a tax perspective.
That's awesome. And I know the US stuff has become very relevant these days because people are looking at the inflated real estate prices here and deciding to make either diversify or take some money to the US. So you guys help with the cross-border setting up the corporations and everything in the US and in Canada and the reporting of it?
Absolutely, yes. Yeah. So we have clients, we have kind of two segments of clients. So the first segment is American citizens or green card holders who live in Toronto and Canada, so they have some obligations to the IRS, so we help them with those filings and annual compliance. We also have the other segment of clients who are moving to the States for whatever reasons they have, either for work or for investing or who just buying real estate there. So we're helping with that, with them with those aspects. Yeah.
Awesome. All right, guys, and before we get into the questions, we have a disclaimer that we want to put up. So I encourage you to pause and read the disclaimer. And essentially the disclaimer is that this is not tax advice. Please feel free to contact Vlad or your own accountant or tax accountant to discuss any questions that you may have. All right, Vlad. So I want to get into some of the topics that we've prepared for, but you know, before we get into talking about losses and how people can account for some losses, can you give us maybe a glimpse of what some of the biggest mistakes are that you see for investors in Canada, and you know what you've encountered in recent months anonymously?
Yeah, absolutely. So I've been practicing tax for over decades. I've seen a lot of a lot of different stuff. I'll share some of the common issues that we see usually when clients come to us asking for service or help. When you have a property, let's say you have a house, you live in it.
Yeah.
Then let's say you decide to move to a different city or buy a bigger house.
Yeah.
You still keep your existing house, but now it becomes a rental property. Okay, so for tax purposes, it's actually a deemed disposition. So you deem to have sold the house at the fair market value. You know, assuming that this is your only residence, you could potentially shelter that gain by claiming principal residence exemption.
Yeah.
But if you didn't know about the disposition, you probably wouldn't file the proper forms with your return, and you got in trouble. So because it's a bit of a kind of like it's not a real disposition, it's a deemed disposition. Like there's provisions in the act that allow you to defer the disposition.
Right.
To defer disposition, you have to file an election with your tax return. It's called 45-2, and that election allows you to defer the gain, defer the disposition until actually sold. Mm-hmm. So if you mess that up, you can potentially be liable for some big penalties, and potentially scrutinizing your principal residence exemption.
Yeah. So this is fairly important because this does happen quite a bit. People will buy a property, you know, renovate it, or especially I would say now. You know, what I've noticed is that some people are trying to test the market. They can't sell, and as a result, they say, "Well, I'll rent it out for a year, hoping that the current market conditions correct, and then go to market, let's say next year, right?" So essentially, does the 45-2 allow you to? Well, first off, it's a voluntary declaration, right? So like, it's up to you to declare that you're doing this.
That's right.
And some a misconception might be that if I declare to the CRA, they're going to be suspicious of what's going on. And I would say that's probably a myth, because if anything, does this disposition also allow you to lock in the value at the date that you have a change in use? So let's say you bought it 5 years ago, you have huge gains in the last 5 years. You have a change in disposition, change in use. Does the election also allow you to lock in the value today? So let's say you rent it out for another year. If there was capital gains, it would only be for the 1 year that you're renting out.
So if you want to lock in the gain on your property at the point of change in use, you actually wouldn't want to file the election.
You wouldn't?
You wouldn't.
Okay.
You'll get the appraisal, you'll claim principal residence exemption, you'll file Form 2091 with your return, you declare it, and then you lock it in. What the election allows you to do is allows you to have the flexibility, right? Because the principal residence exemption works the way like you designate years.
Right.
Right. So like let's say you own for 10 years, and you sold it like in a year later, 10 out of 11 will be exempt. Right. So the election allows you to designate for those years. The election also allows you some more flexibility too in terms of having additional years you can designate the property as a principal residence even if it's rented. So here's the classic scenario. So you have a house in Toronto, you move to work. You move for work to Texas, you change in use, you file 45-2. In Texas, you're renting, right? You can actually claim up to 3 years the property as principal residence while it's rented. So it gives that flexibility.
Oh,
too.
Nice. Okay. Well, that's neat.
So
yeah.
I think the way I look at this election is it gives you flexibility to plan.
Yeah.
And make later on, looking back, make the decision that is most beneficial for your tax purposes.
Right. Okay.
Because right now you might lock it in, but maybe next 10 years is going to go up again.
Yes.
As we remember 2017 correction, right? We thought it was the end of the world, and then here's 2022, and then we're way higher.
It might be the end of the world, but it's not yet. Yeah. Okay. Yeah, it looks like there's a common theme around leaving Canada to go elsewhere. That's where a lot of the mistakes are coming from.
I would say it's a more complicated area of tax.
Yeah.
And changing use is another aspect.
But you guys have experience in that.
Absolutely.
You're licensed in the U.S. as well, right?
Yeah. I'm Canadian licensed, U.S. licensed. Yeah. We help clients with all those matters.
Cool. Any other big mistakes that you want to touch on before we move on?
Yeah. So another one I wanted to talk about is short-term rentals. That's a big topic now. Everyone's trying to do it. Right. So not everyone knows this, but essentially, a short-term rental revenue is subject to HST.
Okay.
HST, depending on the province. If you exceed $30,000, you have to register. There's no choice.
Yeah.
Right. A lot of clients miss that registration, and therefore they're subject to HST. And then, as you know, CRA can go back 7 years, and then, if you have rental income, you could be a potential big liability there.
Yeah.
And then another point is when you start a repeat business, you usually spend a lot of money on furnishing.
Yeah.
So when you pay for the furnishings, you're actually paying HST too, so you can get that back.
Right.
Which could be a significant cash inflow. That's going to help, with your startup costs. That's something to really think about. And another consideration here is in Toronto is MAT. It's the municipal accommodation tax that needs to be remitted to the city of Toronto. They monitor that, and there's licensing and all that stuff involved too. So something to also keep in mind. And sometimes these things get missed, and again, results in just liabilities. Yeah,
it's a very relevant topic right now because what I've seen is that as cash flows become very limited, a lot of people are changing their strategy from long-term rental to short-term rental and going the Airbnb route. The $30,000 limit that you mentioned, is that based on gross income?
Yes.
Or, gross income?
It's based on your gross rent,
Okay.
Annual.
Yeah.
And they look at there's a specific way they look at it. It's quarterly. So if you have any 4 consecutive quarters where you exceed 30,000, you'll have to register. So in the same Q3, Q4, and Q1, Q2, you made 30,000, you'll have to register.
Right. Okay. So as a result of that, when you have bookings, you collect HST on the I think on the Airbnb website it'll collect. So that you have to monitor that in a separate account, collect it, and then remit to the CRA.
Yeah, so Airbnb is actually, the actual platform works pretty kind of interesting. So they've recently introduced the fact that they're actually going to collect for you the HST. So they collect on everyone's bookings.
Right.
Okay. Even if you're less than $30,000. And they collect in bulk and remit for everyone. Okay. If you exceed the threshold, you'll need to register to get your own number. And you put that own number, your RT number, into the platform, and then the Airbnb platform will stop collecting from you.
Okay.
So that's going to be your responsibility to adjust your pricing and remit from your net from your gross rent.
Right.
So that's actually another mistake that people make because they assume that they're taking care of everything, right? And then in reality, they're just doing in bulk collection and remittance.
Yeah.
And then you end up stuck with these HST that you paid on purchases, and you can't really claim that back. So it becomes a bit of a mismatch.
Yeah.
So you have to make sure you're registered. If you need to register, your HST number is there.
Yeah.
I would recommend that everyone who's even under 30,000 would register.
Yeah.
Because they're gonna get the HST back on the purchases.
On the furnishings.
On the furnishings.
Okay.
And usually it's like $20,000, $30,000 startup costs.
Yeah, exactly. Yeah. Okay, cool.
Right.
Good stuff. Okay, all right. So let's talk about what's happening in Canada. So, the economy is changing. Real estate prices climbed quite a bit, 20-30% in 1 year. And now the market has slowed down in terms of rentals. People are now starting to, I've seen a huge influx of rentals coming into market. What are you seeing in the Canadian market? Are people transferring assets from personal name to corp, vice versa? Are there structure changes? What are people doing with their real estate assets here?
Yeah, so there's definitely a big change now, and I think everyone's trying to kind of survive these increased rates.
Yeah.
That's definitely a big issue. And what I'm noticing is that a lot of investors have too much debt, right? They have too much debt, they're over leveraged, and that pressure, the cash flow pressure, forces them to make some irrational decisions, which they might not make if they had the cushion, right? So they're forced to sell, or maybe they bought it with an intention of renovate and sort of flip it, but now the market doesn't work, but they got all this debt to finance the construction. They're kind of forced to sell, and as you said, some of them, instead of like flipping it, decide to rent it out and wait it out. So that's kind of the general theme. In terms of transferring from your personal name to a corp, that usually comes with a significant cost, especially in Toronto, because on those transfers, you'll have to incur land transfer tax,
right?
Which could be a very, very big cost, and so it's rarely done. You can avoid defer the income tax by filing rollovers, like Section 85 rollovers, but land transfer tax is always going to be there, so not really a good path that I recommend. I think the biggest thing is just too much debt.
Too much debt, yeah. I guess with the debt, so if it's, let's say, if it is an investment property, in terms of write-offs, right? So I guess if people have used HELOCs or line of credits, there's some deductions there. But otherwise, if it's, let's say, a principal residence, so let's break it down into two parts, right? If you've purchased with a line of credit or HELOC, what kind of write-offs do you have? Question number one. And then question number two would be I forget question number two, but you answer question one and then I'll think of
for sure. So you have to, when it comes to interest deduction, you have to match the funds with the asset, okay? So if you're pulling equity out of your principal residence, which is non-income generating asset, you live there, but you taking equity out with the purpose of investing, that interest becomes deductible.
Right.
Okay? So you have to deduct it in the, however structure you choose against that rental income or against that, I guess it will be rental income, capital gains like later down the road if that's kind of what you're planning. Another, speaking of mistakes, right? Another mistake is like, let's say you have a rental property, you refinance it, but you buy another rental property.
Yeah.
So it's important to keep these loans separate, not to commingle them, because the other loan that you took out, HELOC, will have to be used against the income for the second property.
Right.
So you kind of have to keep it separate, and it's going to be up to you to prove to the CRA that you use these funds to invest. Otherwise, it's not going to be deductible.
How do you prove where the funds are going?
Yeah, you need to be able to show. You need to be able to show the flow of funds.
The flow of funds.
Yeah. Okay. So you got the refinancing. They give you 100,000. You put the 100,000 down payment on the property, and you can clearly show it. And they're very, very strict.
Right.
If you can't show a clear link, they'll disallow it.
Okay.
Right. So it's important to have good records.
Right. Okay. I remember my second question. My second question was going to be, so we know that from 21 to 22, a lot of people were going into variable mortgages. So let's just talk about like your principal residence, for example, right? And with variable mortgages, some people were in the non-incremental increase. So they're their payments stayed the same, but more of their payments, essentially all of their payments went towards the interest portion of it. So with everyone working from home, in terms of home office expense, you now have a bigger interest portion on your mortgage. Are you able to write off the interest on your mortgage if you're working from home?
That's a good question, and the answer to that kind of depends on what kind of income you're earning.
Yeah.
So if you're self-employed individual,
yeah,
who has either sole proprietorship T2125 on personal return, or they have a corporation, the answer is yes. You'll deduct a proportionate share of that interest, proportionate to the square footage of your home office. However, if you're an employee, right, it gets a little bit more difficult because with employees, it's a different deduction. It's going to be as employment expense. Right. And normally, employers, you have to go with a detailed method, and employers are reluctant to sign that form a lot of the times. And what was happening in the last two years is the CRA introduced a simplified method for deducting employment expenses, like $500 a year. That's all you really can. It's like $2. I think it's $2 per day.
Per day,
So that's the simplified method most people opt for. So if your mortgage experience is going up, like, you're not going to be benefiting from that.
Right. Okay.
But if you're self-employed and you have a business,
different story.
Absolutely.
Okay. Cool. All right. Let's talk about some losses. So, in the event that you have a rental property or multiple rental properties, and now we know that with interest rates, a lot of investors are on variable mortgages with the ability to refinance, or if they want to sell, to buy out a partner. So with variable mortgages, that variable rate's going up. Well, all rates are going up, but your cash flows are very limited, and at times some people are running negative. So, in terms of investors, we have people who own freehold and then people who own pre-construction. Let's assume that you're running at a loss, at a monthly loss, which equates to an annual loss. What can you do with those losses? I think in Canada we've always been used to profits with rental income, but now that there's some losses, how can you account for those losses? Can you carry them back, carry them forward? What are the rules there?
Yeah, for sure. So there's generally two types of losses. One is called non-capital losses. One is capital losses. So the losses that relate to real estate rentals would be considered non-capital losses.
Okay.
So the general framework and the rules around those losses, whether you have it in the corp or personally, are the same. You can carry it back 3 years, and you carry it for 20 years. Okay. So we'll talk about personal and corporate separately, right? But before we kind of get into that, I want to talk quickly about the differences, right? When does it make sense to buy it personally, to buy it in the corp, right? So the answer to that question, do you buy real estate in the corp or in personal, it depends on two things. One is, where's the money coming from? Do you have the money personally for down payment, or do you have the money in the corp? You're self-employed entrepreneur, you have a business. So if your money is coming personally, then it doesn't really matter, right? If you have a corp where you have some retained earnings, you can loan it to another corp, essentially defer taxation until withdrawal. So that's benefit number one. Number two is, how many properties do you have? Do you have just one property where you live, or do you have multiple properties? Because in Canada, we have something called principal residence exemption. We touched upon about that a little bit earlier. And it's really important to preserve that, because that allows you to essentially have tax-free gains on real estate. So you would want to make sure that at least one property is sort of your principal residence, where you live, your home, you claim PRE on that, right? The other properties, it would probably make sense to buy in the corp. Again, everyone's situation is different, so it depends on your situation, for a couple of reasons. The first one is the deferral opportunity. You can move money from sister corps, down payment, and the second thought there is that you can plan for the future. Like, you can plan around death tax. You can do some estate freezes. You can pass the assets to your future generations. So with that planning in mind, buying in the corp is easier, because you can freeze the value, you can move it to your kids, and you kind of know your tax and death. Right. So those are kind of like the ideas behind it, right? Now let's come back to the losses. Okay. So losses, general rules are the same, but if you have it in the personal, your rental losses are deductible against all types of income.
Okay.
Right. So let's say you're an employee, you work, you make X number of dollars. And then essentially you have rental loss. That loss becomes deductible against your employment income, which will significantly help.
Right.
It's almost like a RSP deduction.
Yes. Yeah.
Right?
Yeah. So whether you're self-employed or employed, if historically, let's say you've been in a position where you have to remit taxes at the end of the year, if you have losses, then you can carry that forward and you can try and offset it.
Yeah, if you have losses, so you would need to exhaust all your sources of income personally to be able to carry forward. So let's say you have a $100,000 T4,
Yeah.
then you have $50,000 loss. I mean, it's a big loss.
Yeah.
Probably I'll have to look at what
Yeah.
makes that up, but let's assume it's good. Then you're gonna be taxed on $50,000.
I see.
Right. In order for you to carry it forward, you need to have a $150,000 loss, which is a lot.
Mm-hmm.
Then you're going to be able to use it in the future,
Right.
or carry it back.
Or carry it back. Is it common for people to carry it back?
It's I would say it's not common on the personal side.
Yeah.
It's more common on the corporate side.
Right.
Because on the corporate side, it's definitely a lot more common to have a loss in the business.
Yeah.
Then you can use it in the future, or you carry it back if
Yeah.
you had the previous year's paid tax on it. Yeah, absolutely.
Yeah. Okay.
Right.
Okay. Cool.
Yeah, and another thing I want to touch upon here is that the rental income will be considered investment income, and it will be taxed at a higher rate than personally. So for someone who's in top marginal bracket, it wouldn't matter they're on the corporate personally, but someone who's in the lower bracket will pay less tax personally.
Right.
So
Right.
again, that's not a straightforward answer how to hold it, but
Yeah.
there's a lot of pieces there.
Yeah, and I guess another thing to talk about is, in an up market where you have profits left over from, your rental property on an annual basis, you can use CCA to try and reduce your gains as much as possible.
Yep.
If you're in a loss situation, that changes things from a CCA front, right?
That's right, exactly. So you can use CCA to offset your gains, but you can't claim CCA to create a bigger loss.
Right.
So that CCA claim will be limited. And another point about CCA here is that if this is sometimes we see clients rent out part of their house,
Right.
like or a basement, right? So it's important to be mindful of the CCA, because if you claim CCA, you actually could jeopardize one of those elections that we talked about, 45-2, for the change in use, and you can potentially jeopardize your principal residence too.
I see.
So it's claiming CCA, if it's a pure rental property, you'll never want to claim PRE on it, then it makes sense, but you have to be very careful with it, because it can mess things up. And if you claim it and you want to reverse it later, you won't be able to do it too.
Okay.
Because that's usually not allowed.
Okay. Okay, cool. So we talked about rental income. So what if there's a disposition of the asset and you're taking a loss? What options do you have there?
Yeah, so disposition of assets and you have a loss, so it's going to be called the second type of losses. It's going to be capital loss.
Okay.
Okay, so capital losses can be carried forward indefinitely, and you can carry them back. I believe it's also 3 years. Double check to offset against previously recognized capital gains.
I see. Okay.
Yeah, so you can only use them against same type of income, right?
Okay, that's so if you have a capital loss, so let's say you're an investor, and in previous years you've claimed you've sold a property and there's been a capital gain on it, and you've paid tax on that portion in a previous year. This year, unlucky year, you've sold something, you're taking a loss, so you can go back within the time frames that you're allowed. If you pay tax on that part, you can try and go back and receive a refund for it.
That's correct.
Okay,
that's
nice.
exactly right.
And then you can also, if in the current year you don't have any income to essentially offset it against, you can carry it forward indefinitely. You said. Okay. Can you portion that out? So let's say next year you have 20K in gains, following year 30, 40. Can you spread out the?
You can choose. Yeah, you can choose. You can. I mean, you probably want to claim max. So you can. But again, depends on the situation. Maybe your income's so low, it doesn't really matter. Right. Yeah. But yeah, you would want you can choose how much to claim. Yeah, it's up to you.
I see. Okay, cool. So are people? Is this going to be a saving grace for some people who are going forward, they can make sure that they are going to be in a savings, not in a savings situation, but in a situation where they don't have to limit taxes.
Absolutely.
Yeah.
And these rules apply for other asset classes too, like stock market. If you hold in your non-registered accounts, like crypto. Right. There's a lot of losses there, so you can carry it forward. Yeah. So
rest in peace, crypto.
Yes. Yeah. So that's and also when it comes down to deciding like to buy it in the corp or personally, you have to look at your loss position. That's not the consideration to think about. If you have big capital loss carry forwards, you might want to buy personally so you can claim those losses when you sell it eventually, right?
Oh, cool. Okay,
So-
awesome. Yeah. Good to know. All right, so let's move on. What about in terms of joint venture partnerships? So let's say, two people have bought a property 50-50, and now there's some losses. How do you handle the losses in a partnership?
Yeah, so there's two ways to do it. So partnership is more formal structure. It's more of a formal structure that will require filings with CRA. Joint venture is an agreement. Essentially, every joint venture member reports their share of profits.
Right.
Yeah. It's a bit more simple. So I would say, like, if you going with just like a partner, like someone like you really know, the joint venture makes sense. If you're going kind of like with more like third-party investors and raising more capital, to have a partnership, like a fund type of structure, makes sense too.
Yeah.
But from tax perspective, they're pretty much the same. It's a flow through.
Yeah.
You can hold it personally. You can hold it in the corp. It's the same treatment.
Okay. We had a question from someone on Instagram regarding joint partnerships, and the question was, so tax implications for JV partnerships when one partner is on title and the other is not. So in a scenario where, let's say, there's a working partner, and so a working partner and a money partner or a silent partner, and the money partner is on title. So they're on title, mortgage is under their name, but they also have a partner who owns part of the deal, not on title with a JV agreement. I guess you answered the first part in terms of reporting. The partners have the ability to report their own portion of income and loss. But how would you manage the debt?
Yeah, so so the debt part is a bit doesn't follow the CRA rules.
Okay.
The banks have their own like requirements and sort of like rules and who's going to be the guarantor, etc.
Right.
So what would you? I'm going to speak purely from tax perspective, right? So from tax perspective, like you have to look at the agreement. Like who's on the agreement. So if it says 50-50, 30-70, that's how you'll report your income and expenses. Right, reporting to the lenders is going to be up to the lender. How they require that. So from tax perspective, it doesn't really matter who's on title. It depends who's kind of the beneficial owner and beneficial interest.
Okay,
got it.
So I guess to simplify, in a JV 50-50 partnership,
you just report your share.
your share of income and expense.
Exactly.
Exactly. And I guess it should be relatively the same, right? Like it should be
it should be identical. It should be identical. So normally we would prepare financial statements for the JV, right? And then these statements are provided to each investor, and that investor takes that number and reports on his personal return or corporate return if they hold corp.
Right. Okay, cool.
And then one more thing here. So each JV member has the ability to claim their own CCA.
Okay.
So that doesn't have to be the same.
They get the full portion.
They get of the shares. So let's say it's $1 million, $500K each, minus land. You'll estimate the land and back that out, and then you can claim CCA. You don't have to claim CCA. It's up to the JV member.
Okay, but the CCA, is it again the portion that you own?
Yes.
Yeah. Okay.
Exactly.
Okay,
It's going to be 50-50. Just your share.
Yeah.
Right.
Okay, cool. All right, so next topic, we're getting towards the end. Any suggestion for people in terms of tracking expenses, how to do it, what's the best method?
Yes, I think you have to be organized. That's one of the things. So what I normally recommend is for our clients to have separate bank accounts, separate credit cards for the rental activity, so there's nothing personal there. And then you track it kind of like that. And depending on the volume, depending on the properties you have, you might want to use tools like QuickBooks Online, for example. It's one of the softwares that allows you. You can link your banks for different properties, and then you'll report kind of that each property under separate class, right? If you have one property, like just have different accounts. Excel is great. Just extract your transactions, keep your receipts. And it should be good to go.
Okay, awesome. And then last question here. I guess, that kind of summed up the questions I had. Is there anything else that you want to talk about? Anything else that stands out to you?
Yeah, I mean, I just wanted to kind of touch upon quickly here on death tax. I mentioned that briefly. So
yes,
it's a big topic. It's very kind of complicated. So I'm not going to go into all the details.
Why don't you explain why it's so it's so complicated, and why it's relevant for people to understand. Because so what happens in Canada when you die?
Yeah. So what happens in Canada when you die? When you die, when all of us are gonna die at some point, not live forever, unfortunately. We're gonna face this death tax, right?
Yeah.
So essentially, it's a deemed disposition of all of your assets.
Yeah.
Okay. So we have spousal rollovers, automatically goes to the wife, but when the wife passes away, it's gonna happen. So at the death of both spouses, we're gonna have to face that. And essentially what that is like you deem to be disposed of all of your assets at the fair market value on date of death. So if you have real estate, you're gonna deem disposition. So your kids, your estate will be left with this huge tax bill that you deal with. Disposition of real estate, investments, RSPs, TFSAs are fine. So that's a big thing to really think about and care if you want to leave more money for your generations versus to the CRA.
Right.
You have to plan for that.
Okay.
And that's where holding the corp and all that estate planning is like really important.
Yeah.
Something to be aware of. Yeah.
Okay. And so if someone, let's say you have someone that has a principal residence and one property, versus someone, let's say, who is a seasoned investor and maybe they're a property 510. I assume it's more urgent for someone with a bigger holding to kind of consider it now. But if you're just starting, you have some time to kind of prep for these things. Obviously, the sooner the better. But in terms of urgency, you would say it's more urgent for someone with a bigger holding to kind of start that conversation now and plan for it.
Absolutely, and then there's tools to do it. I mean, life insurance is one of those tools that allows you to essentially cut the tax bill in half or 30%. By buying proper life insurance products, you could save. It's kind of an investment. That's one way to do it. But planning ahead and planning early is key. Right. And someone who has a lot of assets, they're gonna have a big problem. And then unfortunately, what happens is when they pass away, there's this big tax bill, and they're not ready for it, and there's no liquidity. So what they need to do, they need to sell. So now instead of like giving these assets that you've earned and worked your whole life to your kids or grandkids, you end up selling it, paying the CRA half, right? And that's unfortunate. Right?
So you guys do estate planning, or
we do some, Okay.
Yeah.
We do some. We advise on proper steps, and then I work with other accountants and insurance guys to like build a plan. For sure.
And I guess it's just not real estate, right? Any asset you own is deemed to be disposed at the date of death.
Any asset, RSPs too.
Yeah. Okay, cool. Awesome. Cool. That's all. Thank you, Vlad.
Thank you. Thanks for having me.
So if anyone wants to connect with you, what's the best way to connect with you?
Absolutely, you can reach me by phone, 647-598-8777, or email me at vlad@alyokhincpa.com. It's VLAD@ALYOKHINCPA.com.
Awesome, and we'll leave your contact information in the show notes so people can connect with you.
Sounds good.
Awesome.
Thanks so much.
Thank you. Thanks everyone for watching. As always, if you want to connect with any of us, our contact information will be in the show notes below. And Vlad, again, thank you for coming. Wealth of knowledge, and I hope if people have questions, they can reach out to you.
Absolutely, my pleasure. Thanks, Saman.
Perfect.